We'll get over here out of your way.
Perfect. Ready, Preston? Okay. Good evening and welcome to this evening's installment of the Swan Global Investment Hawk Tank Workshop Series. And we are coming to you from Fort Lewis College's Center for Innovation in historic downtown Durango, Colorado. We'd like to, as we start every evening, we'd like to give another shout out to two of our really generous sponsors for Hawk Tank, our presenting sponsor, Baird Wealth Management, as well as our sponsor, Four Corners Innovation out of Farmington, out of San Juan College. This evening, we have a especially wonderful program. We once again have Mr. Gary Masner, who will be talking about making financial projections. He'll also be introducing his 5-year financial projection model that he's created for the Hawk Tank Business Plan Competition. And what makes this evening even more special is we have Fort Lewis College's Beta Alpha Psi joining us in the Innovation Center to help Hawk Tank participants that are in the house as well as that are joining us remotely. I want to do one quick reminder. Well, I'll remind you again at the end of tonight's workshop is next Thursday, we'll be coming to you from San Juan College. This is a very special workshop. This workshop is going to be led by Beta Alpha Psi, and this will be an opportunity for our participants to start sharing their financial models, getting feedback on their financial models and on their projections. This will be an RSVP event. Either if you can make it down to Farmington, to San Juan College's beautiful campus, or if you're going to be joining us remotely. But because of the logistics and the travel involved for Beta Alpha Psi, this is going to have to be an RSVP event just to ensure that everyone, in fact, is taken care of. So, without further ado, thank you so much for joining us, Mr. Masner.
Thank you, Professor Valdez. And welcome everybody to this session. And this is the one where finally you could say, or we have to get to it, but you're going to take now those assumptions, the insights, the analysis you've done about your business model, the canvas that you did, all of the things you've started, the market analysis, and some of the sales projections that we've talked about, and you're going to now try to turn those into numbers, right? You're going to have a look at your business and see whether this model is workable. Is it going your business model? Is it going to scale? Can you build something of pretty nice value for a reasonable amount of capital required? So that's what we're going to end up with today. You'll see. We'll go through some financial projection slide deck first. Then we'll show you the actual model and how to use it. It is wonderful. Beta Alpha Psi has been involved for several years now in the process, and they're a great resource to help you really understand some things. They get the terminology, right? I'm gonna give you some of the financial and accounting terminology. I'm gonna talk a little bit about some of the three financial statements that every business creates essentially every month. But we're not going to try and go into it in great detail because you're not trying to prepare really specific financial statements. You're going to get all the main pieces of it. What you're really trying to understand is how much capital do I need to raise to create and scale this business? So that's what we're going to call capital being either debt or equity, right? And in early stages, it's pretty hard to get debt financing typically, but if you have equipment or other things that that they can get, then you have a better chance of getting some debt. But that's not where you're not going to worry about that right now. That's certainly if you're going to launch your business, you need to put that capital plan together. But right now, especially for this competition, what you need to do is understand, here's how much capital I need to raise to build a business that I think is going to be this much value in 5 years. That's the sort of time frame we put on it. Longer term, so investors and other people, I mean, you're going to be worth X amount in 5 years. So that's what we're going to talk about. We'll talk a little bit, I'm going to try 90x% of what I talk about is going to be very germane specifically to this competition, but I'm going to throw in some other opinions, if you will, that I think that are just kind of important as you actually get out there and you either try to scale this bit or try to start this business that you've got the idea of, or go into another business. And it also goes to what I think is important for the people that are in the accounting and finance profession to really think about how they need to translate results, translate financial statements from GAAP, which is accepted accounting principles, as put forward by FASB. And there is a big gap between what they do and what I think helps small companies, and that's not a positive. There's a certain way they've got to do things, but then, they can help you translate some of that into what's really important for the business, and that's cash flow, which we'll get to. So again, any questions from anybody, either if I'm not being clear enough, or you just want some more detail, obviously stop, and we've got the online questions coming in as well. So in general, financial projection. And the term for financial projections that you'll hear a lot is pro formas, right? I mean, Latin, everything, hide it in another language and you won't understand it or something, but pro formas, it's your financial projections. And you really need to make those, not only for this competition, of course you need to, but in general, in your business careers, you're going to need to be doing that. Right now, you're doing it to really evaluate the attractiveness for yourself and for judges of your business model. But if you're out there trying to think about a business, you obviously need to go through this process. If you're going to sell stock as part of that, investors want to see, what you're projecting as the future, what you're projecting as the value that they're going to hopefully share with you someday. When you go for a loan into a bank, they demand financial projections. Okay, that typically at least a couple of years, sometimes they'll go out 3 years, not usually more than that, but they just want to know that. You need it too to be able to do your annual budgeting, to kind of manage your expenses, have something that the people that are reporting to you, that are running certain departments, they've got their own budgets. You've got a sales force that's trying to achieve a revenue projection. So all those things when you're running the business are incredibly important. And there are various, you can pick different time frames for what you are doing your financial projections for. You'll see in a minute, and when we get into the specific model, for this competition, and for almost any startup company, you need a relatively long range, 3 to 5 years, like I talked. You don't need to do month by month. Okay, it's hard enough to do projections of all of these things. We ask you to do, for the competition, quarterly projections. The model's built like that for the first year, just so you can see how you build things up during the year, when you have to take on certain expenses, when you have to spend some money for assets that you need, how you're going to ramp up during the year, your sales projections, and then after that, just annual for the next 4 years. But if you're running short of cash, when we started our rocket engine testing business here, gosh, a decade ago, I can't believe that, but even more, we spent all the money we had building the facility and doing some other stuff. We had some contracts. Cash was coming in slowly. We owed people. I was doing week by week cash flow projections just to see how we were going to survive for the next month, basically. Luckily, we made it through and scaled up pretty successfully. But there are different kinds of things like that. So you can go from week by week projections out to kind of 5-year annual ones. So again, if you're talking about investors, when you're talking about this competition, it's not what you're going to do in the next year, because frankly, the projections for the next year probably aren't going to look too exciting. And we'll talk a little bit more about that. But when you're out year 4 or 5, you've gotten into your market, you've scaled the business operations, you're achieving a level of profitability. We'll talk about some of those definitions of profits. And you really have a sense of what the business ought to be worth, and we'll show you how to even try to put a number on that at the end of this thing, and it's in the model that we're presenting, which maybe you've looked at already. So lots of reasons to do it. Okay, come on, there we go. Okay, so again, we've developed this model specifically for the competition, specifically for startup companies. There are lots of other financial models out there, projection models, and if you want to try one of those, fine. They don't sort of lead you through it. They expect you to have a lot of things already. They're nice systems to have once you're in business and you've got a little bit of history and you understand your numbers better and stuff. But for this one, it's really important to kind of walk through it yourself, think about all the key variables that you're dealing with, everything you built into your business model, and really try to think about, well, it could be this, and make sure that you write down your assumptions. We have a long list of places in the model itself where you can actually say, this is where I came up with this number. Here's what it's based on. And that's pretty important. And then you can go over it with some of the Beta Alpha Psi people or others, or if investors ask you some things, you've got those assumptions that you've already thought through. So what we're going to do, and we're going to talk a little bit about income statement. That's the profit and loss statement. That's your revenue less your expenses. QuickBooks likes to call revenue income. I don't know when they started that process. I don't view that as income. Income is revenue less expenses is some income, right? Income to me is a form of profit, but they like to call it that. I think you can change it. I've never tried to change how the statements come out, but income or revenue, we're going to talk, when I talk, being old and old schooled, I want to talk revenue or sales, not income. So you start there, and then we'll go through some different definitions of categories of expenses as we go through this process. So you've got that's your income statement. That's revenue less expenses on a monthly basis, typically. Then you've got a balance sheet, and the balance sheet is where you put other things that don't sort of flow into your income statement every month, but it's the assets that you have to buy to if you need machinery or anything else to create your product. We'll talk about working capital, the other things, receivables and inventory and things like that. So we'll go into that. We're not going to try, you're not going to balance everything. In a balance sheet, it's got to balance because assets equal liabilities plus equity. But here we're not going to put in cash. We're not going to say, oh, you got to go out and get a loan. We're going to see what cash is required. That's really the main thing you're trying to come up with right now. How much cash do I have to find a source of to be able to fund my business and my business growth? Okay, that's the plug number, and you'll see that in the model as well. Okay, so what you get out of all of this, you'll get some key metrics. You'll see your revenue growth, you'll see your operating expenses, you'll see your profit margins, you'll see a couple of really key metrics, EBITDA and free cash flow that we'll talk about in a minute that are incredibly important. I think the key ones for any business. So, and again, I'll just say it again, keep a list of all the assumptions you made because there's so many things in here, it's pretty easy to forget, well, what did I base that number on? Where's that come from? So make sure you put that in. Okay, so again, and we talked about this a little bit, obviously at the end of our last market analysis section, making your financial projections. That's the revenue projections, your sales estimates. So that's the first thing. Again, we're going to set it. We said this last session. Do units. How many units you're going to sell? Put a price per unit on it. You're going to set targets by quarter for the first year and then annually for the next 4 years. We really want you to, and the model's set up so you've got the ability, if you've got multiple products that you're selling, not just one, multiple ones, or you're selling them through different channels, you can be very specific about the sales through each of those, of each product, through each of the channels that you're using. So we're going to start with a thing that's called gross revenue. And gross revenue is kind of the list price, if you will, of everything you sell. But if you're giving discounts to some of your channel partners, your distributors, your wholesalers, your big customers demand discounts. You can put those in at this next level, and if you get returns, you can put that in there too, and then you're going to come out with a net revenue assumption. Okay, so for instance, if you're selling a product and in this 1 month we hope to sell 1,000, but we're gonna expect 50 units are going to be returned because people just didn't want them. You put it in there and you come up with a net revenue number. Okay? And same thing with churns if you've got a subscription business. You don't have to put in sales tax. Okay? You're just collecting sales tax for the entity that's taxing, whether it's city, county, and state, and then you're just passing it on. So those sales tax you don't worry about in these projections. You're gonna, you'll see what increase happens year to year, and it's got to be rational, reasonable. You've got to say, given our marketing, given the size of our market, given how we think, our product lines up with the needs of those markets, our pricing, the support we're going to have, everything we're doing, we think we can achieve this kind of sales growth. Are you going to do a 5x every year for 5 years in a row? Probably not. Okay, so have a reasonable one, because again, whether it's investors, bankers, judges for this competition, they're going to look at that and say, are they being realistic here? Okay, so be realistic. Really important. We also talked last time about having, that we all, because you're so optimistic, we tend to overestimate these things. So you're going to do you're going to do what you think is not a best case. You think it's a reasonable case, okay? But then once you're done with that, go back in and trim your sales numbers some and see, gee, if things don't turn out quite as well as I thought they would, now how does that impact my cash needs? I guarantee it will increase those somewhat.
Gary, how do you recommend that approach? Do you like when entrepreneurs come to you and they give you sort of worst, best, and middle scenario, or is it where you just like them to come up and say, okay, this is what I projected, but you know what, I'm going to cut it by 25% just to be really conservative? What do you prefer?
Sure. So what what I like is we think we can do this. We haven't been overly optimistic. We think we can achieve this, but if we can't, here's a lower estimate. Now you only do that typically. I don't think you're going to be presenting those two cases to the judges, right? But if you're talking to investors, they're going to say, well, what happens if you don't meet those? And you're going to say, well, I just happen to have a more conservative estimate here that shows what it's going to be. So you don't sort of lead with two different ones. You lead with what you really are comfortable with, that you can support, okay, again, with the assumptions you've made, but you come back with that.
Thank you.
Okay, and then again, and we talked about this a little bit before, identify adjacent markets, whether it's another product that could be sold to the same customers that you've already got, whether you could upsell them or cross-sell some other product. Identify those, but don't try to build in everything you potentially could do in the next 5 years. Have a series of statements that say, hey, this is our main market, we're going to focus on that, we're going to win in this one, and when we do that, here are 3 or 4 other products that we think we can introduce to this market, and you can throw out a statement, could increase our sales by 25 or 40% or something. So, but don't try to do everything, don't try to introduce every product you think you could possibly have in the next 5 years. There's just too much in there, it's too complicated for people just to wrap their head around, and it also shows that maybe you're not focused enough on really winning first in the market, in the key market you're going after. Okay? So that's revenue. Now you start your expenses, and the first category of expenses are called, in general, in the older days, cost of goods sold. Now sometimes we call it cost of revenue, cost of sales, but it's those costs that are directly related to any single sale or any single purchase by a customer. Okay, that you're going to have those costs when you have specific sales, and they're going to, in general, be for every sale an increase as your unit sales, your revenue increases. So, and as we talked about in the last session as well, early on, especially if you're a product company, a consumer product, your cost of goods sold they're not going to be ideal. You're not, you're just starting out, you're not efficient in ordering, you can't order big quantities at a lower price of materials, your manufacturing process is probably not totally efficient. You're going to have a higher cost of sales that over time, you think you can bring down, and you'll show that in your model. You'll show your per unit cost of goods sold coming down as you get more efficient, both in material purchases, in manufacturing efficiency, shipping efficiency, all of those things. So you'll see that. You should hopefully have a positive difference. We'll talk about that when we get to gross profit, but you hope that your cost of goods sold isn't higher than what you sell it at, because then you have a problem that you better get that cost down really rapidly, and that's kind of hard to do sometimes. So that's a consumer product company. A service or software kind of company, those tend to have smaller direct costs. You build, or they're more determined and they don't go down over time. So if you're an accounting business, you've got people out there on a billable hours basis, they're going to be utilized at a certain billable rate and billable hours, and those things don't change as much. So you're not going to see as much efficiency scale or other things with a service or software business. But you also ought to see, a more profitable business typically to start with. So when we take away these costs of goods sold from revenue, we come to the first profit margin that almost all companies look at, and that's called gross profit. Okay, or gross margin. So gross profit is a dollars term. I made this much gross profit. Gross margin is that gross profit divided by revenue. Okay, and again, as a product company, especially consumer product company, you're going to see that gross margin improve as you scale up the business and get more efficient. So a key one. But it does vary by industry. It's not the same. So as I show down here, software companies, they typically will have an 80% gross margin, right? I mean, they don't have any real direct costs. They've created this product. Sure, they've got customer support. They've got a few things. They've got some servers someplace, but they don't have high cost of goods sold. They tend to have high operating costs. Where manufacturers, and again, depends on what kind of manufacturer you are. If you're sort of churning them out off a big assembly line, you probably have and you've got competitors, you've got a relatively low kind of 20% gross margin, but you got a lot of volume, a lot of sales going on, so you can cover your operating expenses, which we'll get to. If you've got a unique product, backed with something, and maybe you customize it for customers, then you can have a significantly higher one. So in manufacturing companies, we see a relatively large range of gross profit. I've got 20 to 60% here. And then things like grocery stores, retail stores, I mean, they get a lot of volume, turn it over, but they don't, and their expenses are kind of, more tied into real estate and things like that, but they have a very low gross margin and they just make it up hopefully on volume and stuff. So you can compare yourself. You can say, okay, am I even in the ballpark? I have this kind of a product, this kind of company. You can look at public companies, and you can look at their gross profit. You can see it on different sites. I think I'll show it in a minute when we get to operating expenses. But there's the SBDC has some really good data on private companies in different industries. You can go on Yahoo Finance and look at the financials of almost any company you want to pick. And just see, gee, I'm saying I'm going to get a 60% gross margin, but the 4 or 5 public companies I look at are down in the 30%. What am I missing? How come they're not higher? Why do I think I can beat them that much? So it's always good to, make comparisons just to make sure, again, that you're in the ballpark in terms of your assumptions on things. So that's gross profit. That's taking out from revenue, taking out cost of goods sold. Now we get to the next one, which are in general called operating expenses. Okay, and those are the ones that tend not to be direct. Yes, you need them, or you couldn't have a business and you couldn't make, you couldn't support your growth, and you wouldn't have, you wouldn't have things that'll create revenue, but they don't vary kind of directly with revenue. It's more like, not necessarily fixed, because a lot of them are somewhat variable costs, but they're just not going to go up in that same sort of per unit sale number and stuff. So operating expenses, generally we report them by function, and the three functions that everybody uses are R&D or engineering, sales and marketing, and general and administrative. Okay? And within each of those, take sales and marketing. You're going to have a sales force, you're going to have a marketing department or advertising department, you're going to have some different things. In G&A, you're going to have accounting and legal and management. So even within function, you really want to look at your departments and try to say, well, I'm probably going to have 4 people in this one at the start, and that's going to grow over time, and I'm going to be spending this much money on advertising and different things. So that's where you put those kinds of expenses. Here's the legal support I need, the accounting support. Accountants charge, right, these days, don't they? Oh yeah, I thought they did. Okay. So, so all of those are in there. And I would just say, and this goes back to general business and general accounting, it's incredible to me how many businesses I see where their books are set up. So when you first set up your accounting system, QuickBooks we'll talk about, the accountant sets up a chart of accounts for you. That's where every single kind of different kind of expense, or every expense goes into a different kind of a category, depending on how you've determined that you want to have those set up and how you want to kind of manage it. Sometimes what they do, and I don't know if it's to make it easier for the bookkeeper, or I don't know why it is, but I've seen so many businesses where payroll is just a general category. It doesn't matter what department you're in or what level, anything, they just put all payroll in one cost category and says that's your payroll. Well, it's nice, you know what your payroll is, but how do you manage it? How do you compare where you think you should be in sales and marketing payroll and G&A and your engineering department? So it's really important when you do, and you'll see that we ask you to do it in this model to break it down by those departments, but make sure that if you are setting up a business that you get the accountant, the CPA who's going to set up your chart of accounts to really ask you, how do you want to manage this business over the next few years? How do you want to budget stuff? What do you want to be tracking? And you set it up that way, not the easiest way it's going to be and the fewest chart of account or the fewest accounts that your bookkeeper is going to have to put things in. So pretty important. Again, you'll see in the model, fairly straightforward, but you are going to have different types of expenses within every department. So whether it's personnel, outside services, all of those things. So you put in, again, you're making assumptions on what it's going to cost you. And you do want to think through, again, as I said before, some of these are going to be fairly fixed. Once you have a controller, the chief accountant in your company, you just need one of them, right? That person should be able to handle growth over a long period of time. Sure, they're going to need increased support on their accounting staff over time, but some are fixed. Others are, more variable, and maybe your marketing, your advertising budget could be pretty variable with your revenue. It's going to cost you about the same amount of advertising expenditure to capture every new customer. So think through and make an assumption, yes, this is more fixed, that maybe it's only going to grow 10% a year or grow at 10% of my revenue increase. My others are going to be pretty consistent with revenue growth. Maybe they'll grow at 50% of revenue rate and things like that. So, okay?
Gary, can I ask just a quick question? And at a previous slide, when you were talking about cost of goods sold, and that over time, the expectation is cost of goods sold will decrease. And I understand it's because of the learning curve. I understand it's economies of scale. But how would the Hok Tank participants or any entrepreneur show that in their financial modeling? Is it that that they would just see a decrease, and that would be one of the assumptions?
Yes.
Is that sort of how that
Yes.
plays out?
Yeah, you're going to see it in the model that what you're going to have is, you're going to show the various components of your cost of goods sold, and you're going to show what they are per unit over each of those 5 years, right? So you're going to, like materials, let's say, you think as you order better, bigger quantities, you're going to be able to decrease your material cost per unit by 5% a year or something. You just put in those kinds of assumptions, or that your shipping department, sure, they're going to start out here, but they're going to be able to handle stuff better over time. I'm going to need, fewer, they can handle more packages, they can handle more whatever, because I'm going to automate some of the processes for how we create labels and package them up and things like that. So again, there just aren't a whole set of very hard specific formulas you can use for that. You're going to have to make some assumptions. You're going to have to think it through. You ought to have some rationale for why you decided on something. And hopefully you're going to get the beta alpha psi people saying, well, that looks a little bit aggressive to me in terms of, and you think it through, see if you can back it up, see if you can convince them that you're not being overly optimistic and so forth. So
Thank you.
Okay, so again, what you can see in this analysis, what you want to do is take each of those 3 major functions, R&D, sales and marketing, G&A, and say, okay, though, and not broken down by each department within them, gets too specific, but in general, my R&D expenses are going to be 7% of sales. And do I think that'll get a little better over time because they've created products, they keep selling, they don't have to create every new product? Sure, they'll get a little more, but I want to keep doing more products, so I'm going to kind of keep that more or less constant. G&A, you hope, that's one that we ought to see some pretty good fixed component to that cost. So you'll see G&A as a percent of revenue go down over time. Sales and marketing, it's my experience that tends to, again, be more constant as a percentage of sales, of revenue. You see it improve a little bit, but not huge improvement there. But what's good, again, is that you can say, okay, here's what I'm assuming 5 years out, my G&A is going to be, I'll just say 18%. My sales and marketing is going to be 16%, and my R&D is going to be 8%. And if you look at those, you can go into, again, similar companies. Now, obviously, they're going to be a lot bigger. They're typically public companies. But you can say, okay, what's their G&A as a percent of revenue? And again, just look and say, okay, those are pretty reasonable assumptions because, yeah, my rates are higher. My percentage of revenue is higher because I'm smaller, not as scaled up as they are, but I'm not way out of bounds in terms of those things. So you can do that as you need to. And again, the SBDC has some pretty good reports for private companies, again, showing those percentages of operating expenses. Okay, and again, the model kind of adds all that up for you and calculates it for you. You'll see that. So you have to put in what the specifics are, but then it'll calculate those things for you. Okay, so now we're talking about operating profit, and now we get to the first of 2 terms. This is called EBITDA, and it's one of those that I suggest in the past, not in total jest, that you name either one of your pets or one of your kids EBITDA, because you'll be saying it a lot over time, because it is the key number. It is the key measure of operating profit. Okay, it's really cash profits that the business is making, and it's one that you're going to use over and over again in so many different ways. We'll talk it through right here, but so it really does reflect better than any other measure, what's the real cash outlay. So it doesn't have anything to do, again, what you'll see in trying to set standards, the Financial Accounting Standards Board, using GAAP things, says, well, we want you to take any expenditure, any cost, and relate that to when it's producing revenue. So if you buy a machine that's going to make your product, you can't just expense that and write it off in the first year or the first month you buy it. they want you to spread it out over its normal working life, right? And so that so you're taking its cost and associating that with the revenue it's producing. And that's just a standard they want to have. And I understand that, but you don't get to spread out the costs. You got to buy that machine up front. So, looking at it, trying to put in depreciation doesn't help you from a cash flow basis. It doesn't help you figure out how much cash do I need, because I had to pay cash for that machine before it created its first product, right? So so again, EBITDA, and that's how I hope everybody's taught to pronounce it. There's I've heard a few odd pronunciations, but it's earnings before interest, taxes, depreciation, and amortization. By the way, amortization is just, I simplify it by calling it depreciation of soft assets. So if you buy an ERP system, a software system to run your business, you don't write it off the first year, you spread it out over what you believe to be the useful life of that software. So, or if you spend money, that's a good enough example. So that's what amortization is. And again, it's the same thing. You're going to have to pay for that software up front. Now, more and more these days, you can get a license for it and spread it out. But the costs of getting it in place are also added to that amortization. So we don't care about those things. We don't care about timing other than the timing of when cash goes out the door. Okay, that's the real key thing that you're trying to really focus in on your financial projections for a startup company or for this competition. Okay, so we also don't care about financing costs. You're not going to put in where your money comes from. This is all, you're going to say, here's how much I need to raise, and you'll put a capital plan together to do that. It's not going to talk about taxes. You'll be losing money for at least first couple of years or something, and even afterwards, taxes, by that point, if you're that profitable and you're paying taxes, your cash flow positive doesn't matter relative to what you're trying to decide in terms of total cash needs. Obviously, it's an important thing. You got to pay taxes, but we'll talk later about how it's just not put into the valuations of companies when they're trying to make comparisons and things.
A couple of questions here. What is your feeling if a Hawk Tank participant said they were going to be profitable in the first quarter? What would you think as a judge?
I'd say that's highly unlikely.
Keep that in mind, right? And I think sometimes we have, entrepreneurs, obviously, we've talked about this before, are very, glass half full. That's the reason why they go into entrepreneurship, or that's why they feel they can be successful. But I think that's something that we want to really keep in mind. Then the next question I have for Mr. Masner is, now, you say that we're doing the financial projections to figure out exactly how much sort of capital we need to operate our business. I've had past participants ask and say, well, my dad's going to give me $20,000 for this business. How do they incorporate that capital infusion into the model, or is that something they don't actually include in that model, that $20,000 capital infusion?
You don't need to, and we'll get to that in a few more slides. But it's really, here's how much capital I need. Now, where it's going to come from, sure, you could have a rich uncle. We always use the rich uncle, or family, friends, and fools, right, that invest in your business, right? So, or angel investors, or wherever it comes from. That's not the key. The key is, here's how much it's going to take. I've got to come up with a capital plan when I really launch, but you don't need to do that when you're first trying to see if the business model even makes sense. Or if you want to win this competition, you don't need to say, here's where it's going to come from. That you can leave. There are various sources that, if the model looks good enough, if the return 5 years from now looks really enticing to potential investors, it's always a problem raising money. It's not the easiest thing in the world, but you'll be able to do it. Okay? We're not trying to say, where's your money coming from? We're trying to say, how much do you need to build a business that's going to be worth this much? That's what this is really trying to focus on. Okay? So in terms of valuing companies, and a lot of, I can't tell you how many different reasons there are to put a valuation on a company. and there's a lot of them, including some that the IRS says when you want to start doing stock options and things like that. But the most common valuation metric is a multiple of EBITDA. Okay, and that's how the databases that track these kinds of things will always try to measure. This company sold for X dollars. That was this much of a multiple on their prior year's EBITDA, and you compare them across industries, across size of deals, across time. Is the market getting more aggressive or not? So it's the major one, and it's used. One company I'm on has an ESOP plan, employee stock ownership plan, and they have to get an annual valuation, and a multiple of EBITDA is one of the two basic ones that they use and stuff. And it's especially important. Right now you could say, well, okay, I can do a discounted cash flow analysis, right? But your projections are already kind of questionable, and no reasonable valuation expert's going to say, well, I have enough faith in your financial, your cash flow projections, so I can use those. So it's really the one to use, and it's not the same. It's different, way different across companies, across industries, and way different across different characteristics of the company. And we'll get into those in the end. We're going to show you how to come up with and try to justify your EBITDA multiple that you think you're going to be worth. So we'll get to that. Bankers, and you can go on, again, any site, and enterprise value is the total value of the company. It doesn't care about whether it's financed with debt or equity. It's just talking about the value of your operating assets. What cash flow are you throwing off? And they'll use that, and you can look, again, Yahoo or Morningstar, which I use a lot. EV, enterprise value to EBITDA, is the classic valuation method that they use to compare public companies. So bankers are going to use it. So there's almost, when you take out a loan, they have some covenants. They say, hey, you gotta show me that you can repay this loan. And one way I look at that, first I see your financial projections, but I don't ever want you to take on total debt of more than, and the typical number is 2.5 times EBITDA. It's a standard covenant in any bank loan. So again, EBITDA is an incredibly important measure, one of the two most important measures, I think, for any company, and one that you're going to use here in terms of coming up with a value. And again, you can look at it across industries, across companies. It doesn't matter whether you're financing with debt and you've got a lot of interest. Doesn't matter if you're a S Corp or C Corp, who pays taxes. Do you have any taxes, or are your shareholders paying all the taxes? It gets really to the operating profit, cash profit that you're generating. That's why it's such an important number. So, okay, so that gets to the kind of month-by-month operating cash flow, right? But now you've got to invest in some other assets to really help support the business, okay? And one of them, the first one, the top of the balance sheet, that's why we put it first. Probably easier to talk about fixed assets, a lower one, but we'll talk about this thing called working capital, okay? And you'll see it on your balance sheet. Up at the top on the asset side, it's called current assets. On the top of the liability side, it's called current liabilities. And what current means in accounting talk is that you can expect to turn that asset into cash within less than a year. So inventory, accounts receivable, things like that, those are current assets. Accounts payable, when you order some material and the company gives you 30 days to pay it, okay, great, that's a liability. You're not going out with cash yet, but they've lent you money essentially because you don't have to pay it for 30 days. You have to pay it within a year. That's a current liability, okay? And we're going to focus, those are three actually that we're going to focus on. So you just got, if you're a product, product company, you got to have some inventory, right? When I just had a talk with one of our companies this morning that, by the way, you should all buy one. He's got this great Wi-Fi speakers with subwoofers, everything built in behind a 1-inch canvas picture, or either a photograph or a painting, and you just hang them up wherever you want, and the whole house, plays them off. It's really going to be interesting. I think he's going to do really well. But anyway, so he's got to have inventory, right? He's about to start a Kickstarter program, and he wants to have some inventory, his circuit boards and the speakers and all this stuff, so that he can charge the Kickstarter people a little bit more to get a really fast delivery and stuff. So he's trying to figure out what he needs to order, when, and so forth, to have it on the shelf. Okay, so, and obviously that's just a cost of, you're paying for that before you sell it, right? So it's a cost that you're going to have to incur, a cash outflow from the company that that you got to figure in that's part of my cash needs. Same thing with receivables. What is an accounts receivable? It's, you invoice somebody. Now, if you're selling online, you're doing all this, you're using credit cards, great. You're getting immediate payment, no receivable. But with different kinds of customers or different channel partners, wholesalers, others, big companies, if you're selling to them, they expect to get payment terms. They don't expect to pay up front. And typically, 30 days is kind of the standard, if there is one, which hasn't changed much over several decades. But essentially, what are you doing? You're essentially loaning, it's a silly way to think about it maybe, but you're loaning money to that customer, right? You're saying, hey, I'm giving you this, but I'm giving you a 30-day loan. You don't have to repay me. You don't have to pay me what you owe me for 30 days, right? That you've shown all your expenses, your income and expenses on your income statement, even on the EBITDA, but you're not collecting that money yet. So you've got to finance that somehow. You've got to have cash to cover all those expenses that got associated with that sale before you collect the money. So accounts receivable is a key one. And typically, and we'll talk about how you're going to put it in the model, it's not that hard. Then again, current liabilities, you've received services or product, but you haven't paid for it yet. So it's the same thing. They are giving you a loan, essentially. The people that sell you materials say, okay, I'll give you 30 days to pay. So they've loaned you, if you will, the money to buy that for 30 days until you've got to pay it. So,
Gary, does that change by industry? I mean, we definitely see this a lot in the restaurant industry. So you'll be given supplies, you can make money from that, and then you pay back your supplier. But is it always 30 days? Are there other industries where it's 60 days? Are there industries where it's cash on delivery? And if there is, how do students or how do participants find out that?
Yeah, so a really good question, by the way. So, and I'll just say, restaurants are one of the few businesses I know that actually have negative working capital, right? They get paid for the food that they sell or the wine that they sell with a credit card, but they typically, unless it's been sitting on the shelf for 30 days spoiling, which it doesn't, they don't have to pay for that food or wine for 30 days for their suppliers. So they don't need working capital money. They actually almost get a working capital loan, if you will, from their suppliers. But others, it's typical on 30 days. Some will say it's 45 days, but if you pay within 30 days, I'll give you a 2% discount. They try to encourage you to pay early. You probably don't have that, you'd rather not get the 2% and get in the early days of your business and wait for 45 days. It depends on how big, the bigger customers can really demand longer terms. Even though they've got the cash, they've got the buying power from you. And I've seen them do that. They don't need they must know you need the cash more than they do, but they still demand 60 days from you and then want a discount and then typically take that discount and pay it. And unfortunately, as a startup company, believe it or not, you're kind of risky in a lot of people's eyes, right? And suppliers often say, gee, I'd love to give you terms, but you got to show me that you can really pay for this, and I want you to pay cash on delivery for the first 5 or 6 months. We're not, yes, when you're really going out and starting your business, you really need to understand that. You really need to talk to suppliers. But I think for this competition, we're okay if you use 30 days as the general expectation that you can get. Okay? Okay. So now there are some other things, again, under FASB things, under GAAP, that if you pay for insurance for your company and you get it in June, well, you're only using up 6 months. So you've kind of prepaid next year's, and they don't like, the accountants don't like to show stuff for in the future. They want current year results. So there's that. You don't care about that. If you're paying an insurance bill, that's cash. It's going out the door. You don't care about splitting it between 2 different years in terms of how you're accounting for it. You will someday, but right now when you're trying to, again, determine how much cash do I need to start and scale this business, those kinds of things don't matter. So really the key things, there are 2 current assets that you're gonna try to come up with assumptions for: inventory and receivables, and then accounts payable as the one current liability. When you take those, so don't worry about other stuff. Okay, so when you net those out, it's called net working capital. Okay, so it's current assets, which cost money, right? Because it takes cash to cover inventory and receivables, less payables, and that's a good thing for you. The more, well, you got to pay it off. You want to be timely. You can't get overextended, but that's the net working capital you need to grow the business. And in general, again, because you think inventory, yeah, you'll get better at turns. We'll talk about that, excuse me, but receivables, they're always going to be kind of 30 days if that's the kind of business you're in. That's going to grow totally in proportion to your revenue, right? Every customer's going to want that. Payables pretty much consistent. So your working capital, and you see this a lot, it's a good measure. My working capital is X% of my revenue. And when I grow my revenue, if I double my revenue next year, my working capital needs are going to double, right? They stay fairly consistent. And so you can use the simple way to do it. We do that in a lot of modeling. When you get more, when you get more stable as a business, you can say, okay, it's just going to grow that much, and I can calculate how much that's going to take to really support my business. So the way to do it, and the way we want you to do it, if you have inventory in your model, if that's your business plan, decide how many days of inventory you think you need on the shelf to support your customers, okay? You want to have enough. You don't want to have customers call you and say, well, I'd like this product. And you say, oh, well, okay, I got to order the parts and it'll take me 6 months, but I'll get it to you. They don't like that, right? They want you to ship it the next day by FedEx, so they've got it 2 days later. So you're going to just say that. And again, over time, as sales volume starts picking up, as other things happen, you're going to be able to get better at satisfying things without having huge amounts of inventory just sitting on the shelf. On the other hand, you're probably going to be ordering bigger quantities of materials to get the benefits of lower cost. And so you're going to have that sitting there until you get to turn it into a finished product that you can sell. So, I would say you should start out with at least 2 to 3 months of inventory in your plan. Hopefully get it a little better over time, but probably not get it down below 2 months of inventory. So another metric that just retranslates it, let me use 3 months worth because it's easier math. So if you've got 3 months worth, 90 days of inventory, you divide that by 360, so 25% of your, I'm sorry. So if you turn it around the other way, that's a 4 times inventory turn. Okay, 360 divided by my 90 days. I'm turning my inventory over 4 times a year. Okay, that's a pretty standard metric that people use in looking at the performance of a company.
I guess I have a couple questions here. Number one, I'm sure there are participants or hot seat participants that are wondering, number one, how do I come up with that number, right? So obviously a little bit we drew by demand. And the second is, I've talked to students before, and sometimes they rationalize and say, well, you know what, I'm going to take an order, I'm going to tell my producer, and they're just going to ship it directly to them. How does that sort of play out? Is that realistic? Of course, students learn about just-in-time, and so they wonder, well, can I use just-in-time production? What are your thoughts on that?
Yeah, well, again, it's really dependent on what the product is you're selling and what your customer expectations, right? So there are some where, again, depending on your business model, you could say, yeah, I'm not actually making the product, I'm acting as a middle person, and I'm gonna, when I get an order, I can go to my suppliers, they have it on the shelves, they can ship it directly. There's some of that, okay? Not a lot of models, I wouldn't guess, that we'll see with that, but you can't do it. So I think, again, here, you really need experience over time. You've made some sales projections, but you may have multiple products, you're not sure how they're gonna move. They may want some customizing of it, like our guy that's doing the picture speakers. Every picture is different, whether it's a photograph they send them that they put on the canvas, or a piece of art that the people pick out and they do. So again, if you've got that mix, you don't know how it's gonna go. And you're just gonna need time and experience to say, hey, here's what it looks like, and now I can really, I'm more confident in my projections. For now, again, you've got to have, I'd say start out, you should have at least 60, that would be a minimum. 90 days is probably more realistic in terms of where you're starting out with that much sales, 3 months worth of sales in inventory to start out, and then hopefully you improve that over time. Okay, good question. Receivable, and again, on your inventory, what you're doing, you're just buying materials, or you're buying things. You may assemble them and have all that. So it's really what you've got to do. It's based not on sales in terms of how much dollars it is, but it's based on your cost of goods sold, right? Because that's where the material cost is. And if you say that, okay, my material costs that I buy from suppliers are gonna be 50% of my cost of goods, then you can put in, 50% of 3 months worth of cost of goods is what I'm gonna need as an inventory level, okay? And I think you'll see that, and again, the Beta Alpha side people can help you through that as well. On receivables, that's really tied, that's based on the sales price, right? So you're giving people 30 days, that's the entire sales thing. So you just take 30 days on, when you're doing a quarter, it's 1/3 of your quarterly sales are gonna be in receivables. When you get out to the annual projections, if you're giving them 30 days, then that's 1/12. So you just do 30 over whatever the period is, times your sales volume. That's what you need to find a cash source to cover those receivables. On payables, it's the same thing we talked about in inventory. They're giving you 30 days to pay for the materials, so you go back to what you just make an assumption. Again, it's going to be a little bit rough, but reasonably backed up. What's my material purchases, my supplies that I buy, as a percentage of cost of goods, and that'll tell you what your accounts payable should be, again, relative to cost of goods, which is very in relation to your revenue and stuff. So relatively easy with one line of assumptions that the model will project that for you. And again, we talked about a restaurant with negative working capital. We talk about other people that charge, only sell on credit cards online. They don't have some of this stuff. Or if I'm in a service business or something else, sure, I'm gonna have receivables, but not inventory. People are my inventory. So every business is gonna be different. You're just gonna have to go through but again, you can compare this to public companies and see, what's their inventory level relative to their sales, what's their payables. You can see all those things if you really wanna, get a sort of test of, have I got some reasonable assumptions here? Okay, so that's working capital, current assets, less current liabilities. The next one we get to are fixed assets. And fixed is an odd term. And to go back, by the way, we were talking about it earlier, your cash flow statement is the most important statement for you to look at. It's incredible how few CPAs really present that to you and help you walk through it and understand it. And FASB made this change since the days I was a CFO, it was easier. They now have lumped together your your earnings, and they make all these adjustments for depreciation and this and that, and then they put in what they call operating assets. Those are current assets and current liabilities. I don't know why they think those are operating assets, but a machine that makes product for you isn't an operating asset, but that's the terminology they use. And they put both of those together, and it is so complicated. What we say is, here's your EBITDA, now take your working capital, okay, and now also the fixed assets that you have to buy. And so, again, we're not depreciating those, you're paying cash for them. So whatever fixed assets you buy, and a fixed asset, we talk current assets, are things that'll turn into they have a life of less than a year, right? You're gonna collect that receivable in less than a year. Fixed assets have a life of more than a year, and you can also put in a minimum value that they have to have for you to have to depreciate them on your accounts. So, but any assets that you buy that you're gonna use for multiple period of time, we're gonna put in this capital expenditures, are what, when you pay cash for a fixed asset, it's called a capital expenditure, or CapEx. And so you're just gonna get those as you look at what I gotta have to start my company. As it grows, I'm gonna be adding these kind of assets, either to fixed assets to make more production, or more computers for my sales staff, or whatever it is. And you're just gonna put that down in the period in which you intend to spend it, because that's when the cash goes out the door to pay for it, right? So that's what we're trying to come up with. So, it includes freight. You're paying sales tax, so now you have to include that in it. If you have to install it, somehow, that's gonna cost you some money. Anything that's gonna get it up and running, whatever that's gonna cost, that's not already taken into account in your other operating expenses. So obviously, if you've got factory personnel that are there and they can install it, but if you have to pay to have it installed by some outside services, or the provider of it, which happens, the Scafab that sells equipment, canning and moving equipment to craft brewers around the country, they charge something to come in and install the equipment and stuff. So that's just part of what you need to add to that cost. Obviously, we say this, you're not going to have surplus cash. You need to conserve cash. The two most important resources that you have are your time and cash, right? And you got to conserve both of those to the best. You've got to really make sure that you're spending those wisely, your time and your cash. So, rent it if you can for a while. Fine, when you start producing excess cash, then you can go out and buy stuff, but rent it wherever you can. Certainly don't buy a facility. Don't buy, if you can rent anything else you can rent, do that until you turn cash flow positive.
I really want to hammer that point home. And I'm sure Beta Alpha Psi will help hammer that home when you seek their assistance. But there have been so many times that I've seen business plans, especially in the Hawk Tank business plan competition, where you have a participant and they put $100,000, $500,000 because they want to buy a facility. And it wrecks their model. And then they really see that, they almost feel like they can never be profitable. And so really take that to heart, this notion of anything you can rent, that's really most likely your best approach.
Exactly. Yep, good. Okay, so again, in each period, whether it's each quarter for the first year, or then each year, you put down, and there's a list, you'll see it in the model, of exactly types of assets, and you just put in what you think you do need to purchase for cash. Okay, so now we're going to combine all these three things, and we're going to come up with, almost more important than EBITDA, my second thing that you got to get to understand and know and follow all the time, no matter what side of the desk you're sitting on, and that's free cash flow. That's a little bit odd to call it free cash flow, because I can't tell you what you've got to spend in terms of energy and other things to provide it, but it's free because you've paid all these things you need to do to support the business and the business growth. It's now money that can go back to your capital providers. So it could go back to pay off debt. Okay? It could go back to to your shareholders or to you as a founder in terms of dividends or repurchase of stock or something. So it's money that you don't need anymore to fund the operating assets of the business as it grows. This can go back to your sources of capital. Okay, so again, it's EBITDA to start, and you're going to be negative for sure in the first early periods, whether it's at least a year, probably 2 years, potentially 3 years. I mean, there are obviously some pretty big companies out there that are still, not making money, whether it's Uber or you name it, or the EV company, most of them. They're not even free cash flow yet. I mean, you look at Netflix, I think finally got to free cash flow last year. I mean, really, guys? It took that long to get there? But, so it's EBITDA less the money you've got to put into working capital to support the growth, less the capital expenditures that you pay for. So after you've done that, you've funded the growth, you've funded the company's needs, and now you can use that to pay back capital. So what you're going to have, and again, cash burn, we use it a couple different ways. Cash burn typically is your negative EBITDA for a certain period. You're going to have other things. You're not going to be cash flow positive. Okay, you're not going to have positive free cash flow early on in the life of your company. It doesn't happen. It's a chasm you've got to cross, a cash need chasm. And the question is, how wide is it? That is, how long a period does it go, and how deep does it get, right? If you need, if you need 20 to 50,000, okay. If you need 2 million, like one of our modular home builders that wants to start a factory, yeah, that's a lot, right? And it's a big difference. So the breadth, width, the length of time, that's the width of the chasm you got to get across, and the depth of it is how deep it gets and stuff. And that's going to say a lot about what you need and what your prospects are. So you're going to, again, for certain periods of time, first 4 quarters, maybe another year, maybe 2 years, it's still going to be negative. At some point, it starts turning positive. Good. Now you've reached the cumulative amount is the total depth of that chasm, right? It's the total negative negative cash flow. It's a total amount that you've got to find a way to finance, to find a source of capital to cover that. And the model, you'll find, figures out what that is and puts a nice light red color in the cell.
Can you say that one more time? I think that's really important. So remember, the whole idea with the financial model, the whole idea with this forecasting is to try to figure out, hey, how much money do I need to have this dream come to life in order to serve these customers, right? And so when you see the negative free cash flow, is that the number that they're going to be ultimately?
The cumulative, the maximum cumulative. Obviously, when it turns positive, you don't need more, you're paying some back and stuff. So it's the negative, it's the cumulative, it's the maximum cumulative negative free cash flow. That's the amount of money you need to raise. And you should raise a little more than that to be protected, right? Just in case you don't exactly meet all of your assumed sales and stuff. But for this purpose, you're not going to say, I need to raise 20% more than that. You would in your capital plan. But then you're also going to talk about timing of my raise and what sources I use and all that. That's not part of this competition. Part of a final business plan you'd put together if you're going to launch. But for this, you don't have to worry about that. You just have to say, this is how much I need total. Okay? Okay. So, so now we say, okay, I need this much money. What am I using that for? What am I building? What's the value I'm going to get out of this? And again, as we talked about before, we're going to do a multiple of EBITDA. We're going to go out into year 5 because by then, maybe you certainly haven't maximized your growth. You haven't maximized, your improvement in profit margins or your EBITDA margin relative to revenue. But you've started showing, those traction. You've started showing efficiency. So it's a good measure to use. And so 5 years out, you're going to take your EBITDA and you're going to apply this multiple to say, here's my value of my company. 4 to 8 is a rational range. If you look at sale. And by the way, we always do this every time. Doesn't matter when you do an evaluation. It's what a financial buyer would pay for your company, right? Not some company that's going to come in maybe as a competitor and can get some synergies by cutting out half your people or getting into new markets with, because you've got some product, you've got some customers that could use their products. You don't do what a competitor with synergies would do. You do what a financial buyer, a venture capital firm or a private equity firm would pay for your company. It just standardizes the way that valuations are done. And it's what an investor is going to count on because they don't know. It used to be you'd get a venture capital firm or a private equity firm come in, they would they would finance you and then sell you to either you'd go public or sell. Now it flips over to different private equity firms on multiple occasions sometimes. But anyway, we're looking at what a financial buyer would pay for your company. 4 to 8 is a pretty good range. If you look at the middle market, it's called. Now, those are companies that sell for between 25 and 250 million. So it's not small transactions. It's that range. The multiple that financial buyers have paid over the last years has stayed pretty constant at just around 6, a little under 6, 5.9. Now that varies obviously by some of the characteristics, the industry you're in, some of your characteristics as a company, and the size. The bigger you are, the higher multiple you get. When you get down towards that 25 million sale value versus the 250, you're down at a lower.
I have to ask, right, because we're really bullish here, is what's the highest multiple you've ever seen, Mr. Masner?
30-ish.
30, wow.
And we'll talk about some of the reasons why.
Okay, great, thank you.
On our next one. Now, nobody's going to accept 30 from any of these models. And again, you're trying to be rational, right? You're trying to say, look, and we'll talk about the characteristics of the company that could have gotten a 30. Okay, so, and you'll see there's some public companies out there today. There's some public companies that are down in the 5s, the car guys. Ford and GM, they're down in a 5 multiple of EBITDA. There are others, Splunk I looked at today, or some of the other ones that are in kind of tech and apps and or software. They're up in the 30s for sure. And and again, they're growing, they're putting their money in, right? So you got to be careful about what's the stage of my company. So if Uber said, well, I'm just going to keep throwing money at this thing and growing, or WeWork that was really terrible. So they're just saying grow at any cost. So I'm not going to try to be EBITDA positive. I'm going to go out and capture that market. So if people are willing to listen to that, you've got such a low EBITDA that they're saying, hey, I'm looking forward 5 years from now what I think you can be. I'm looking at the cash flow, free cash flow that I think you can throw off 5 years from now. I'm willing to pay you today. It's like what you're going to see. You're going to say, okay, you're going to show your EBITDA multiple 5 years from now. Well, what's that multiple in your first year, right? Because you're losing money or you got a small fraction of what you're making in 5 years. That final 5-year number, you're going to look at, you might show for the first year 100 times EBITDA, the value you're going to put on it. And that's what the market does though, right? Especially in the public market, they're looking forward, not back. And they're saying, what do I think you can be in 5 years? I'm willing to pay you a higher multiple today because I can take this or you're going to take it and really grow it. Or in the case I talked to you about with a private company, they said, wow, you're what I need. I can supplement what's going on and really grow this thing. So, okay, so what are the measures that allow you to get that higher multiple of EBITDA? Okay, and there's a bunch of them. I've got even a longer list that I use sometimes with companies, but here are some of the key ones. Do you have proprietary intellectual property? Either patents or this incredibly strong brand with trademarks that's going to allow you to what? To hold off competition. It's this moat around, and it was Warren Buffett that sort of started that terminology, right? I built a moat around my company castle to hold off competitors, right? And now Morningstar, one of the best firms for sure doing this kind of valuation work and stuff, they actually use that and they say, do companies have no moat, a weak moat, or a strong moat? And they actually will tell you that, right? And you always want to buy strong moat companies that seem to be really undervalued today. Those should be the best deals. But so that's worth more. And if somebody's going to come in and buy you, if you've got patent protection, if you've got a strong brand name, they're obviously going to pay you more than they would for a company that's just an everyday competitor, right? And just is maybe competing on price, which is not what you want to compete on. So that's important because it gives you, again, the sustainable competitive advantage, the moat, really key. How fast you're growing is really important, right? If you're just piddling along, without much growth at all, then somebody's not going to pay you as much. Whereas if they see you can really grow, then you're obviously worth more. You're going to be worth more in the future, and they're going to pay you more today for that. So high revenue growth, we say 25%. If you're growing that much still by year 5, then you're sort of towards the top end of the 8 range. And we'll show you actually the chart that gets you to this number. Recurring revenue, the 30x one I talked about, and we talked about this before a little bit, but it's always easier it should be, unless you're really messing up, it's easier to keep a customer than to get a new one, right? So if you've got customers where they're Netflix, where I'm paying, I don't even know what it is, you lose track of it, $19 a month or $21, whatever it is, you're going to keep doing that, and you're used to the product, you like it. It's true in businesses especially, but consumers too, more and more these days. If you're paying recurring revenue, you're going to, just out of habit or out of inertia, you're going to keep doing it, right? So if you can show that you've got that, that's consistent. You don't need to replace last year's customers, one off each one if you've got individual products. So if you've got recurring revenue, or customers that just come back in and repurchase because they use it up and repurchase your product over and over again, somebody's going to be willing to pay you a lot more for your company relative to your EBITDA level.
Can I ask you a question about the recurring revenue, Mr. Masner? And this is an interesting one because I've seen in other industries that they're really trying to leverage this recurring revenue. I'll give you an example. And they call it almost the Netflix model. Yeah. And the one that comes to mind is there is a second division soccer club in the UK called the Wycombe Wanderers. Mm-hmm. And they've gone to this recurring revenue model. So instead of buying season tickets, what they've said is we want you to buy a membership, which will include your season tickets as well as additional bells and whistles. Right. And so they're charging individuals instead of, I'm just throwing this number out there. And so instead of, let's say, £500 for their season tickets, they're breaking that up into monthly subscriptions. Right. How does that affect things? Does it have an effect? Is it? It's something. They're the first ones to do this
in that specific
industry, right? Correct, and it's actually an American owner, right? That's bringing this model to the United Kingdom. Yeah. So how does that kind of play out? Is that something where participants can think about these sort of really innovative ways?
Oh, sure.
Okay,
it's got to work. Now let's talk about it though for a minute, because there was a company that tried it 2 years ago in the movie thing. Where they said, you pay us this and you can go to any movie you want and we'll pay the theater, and they lost tons of money. They're trying to rebrand and restart right now, but that didn't work, okay? And other companies that were in the license, especially in software, whether it's Salesforce or Oracle or VM, you name it, in the old days, they were, you buy this software upfront from us and you can use it as long as you want. Right? And what's nice about that is you get a whole lot of money up front, right? And you hopefully don't have much expenses going on. But they found that, they're better off and especially when competitors are offering it, so you got to respond to competition. When now they're moving to this, again, licensed basis. You pay monthly or quarterly or annually Microsoft did it right. You used to buy Office, buy it up. Now you pay an annual fee for it. So they've done it. It's being used in so many different industries. It's hard to move from that. A lot of companies have sort of suffered because they used to get all this money up front. Now it's coming in on a monthly basis. So all of a sudden, the revenue doesn't look quite as good as it did before, not growing like it did before, because they're only getting monthly or annual ones now, where they used to get big chunks with new customers. So, but once you've got a customer like that gets in the habit of buying this thing and doing the monthly redo, McAfee, you name it. It's really in the software apps, services things, but more and more companies are trying to apply the model. I see it in financial services, of course, and accounting even. They're trying to say, well, just pay me this much money every year and I'll do everything for you, or whatever it is. So yeah, it's a good model, but you've got to really think it through, and you've got to think through what it does to your, what it means for cash flow as well. Because eventually it's going to be great, but up front, you're spreading out their costs, not just giving them 30 days, you're giving them 5 years to pay, right? Because it's going to take 5 years at the license rate to get what you would have charged. Not 5 years, that's long, but 2 or 3 years at least for you to get these monthly subscriptions that total up to what you used to charge, or would have liked to have charged them up front if they bought it and owned it. But now they're a lifetime customer. Okay, so recurring revenue, sticky customers, really important. High EBITDA to revenue margins, that's important, right? To get a higher multiple. If you say, hey, I'm going to grow my revenue 20% and my EBITDA to revenue is 60%, look at how much my EBITDA is growing dollar-wise, absolute dollars. Whereas if you've got a low EBITDA margin, it's just not as attractive, right? Because you're not getting new dollar EBITDA out of that revenue growth. Capital efficiency is also important. How much working capital and fixed assets do I need to reinvest in the company to support that revenue growth? If it's really high, that every time my revenue doubles, I got to build a new steel plant, that's not as attractive, right? Because what buyers want is they want to see high free cash flow numbers, that you can get with, that your free cash flow to revenue is a high percentage, so that that when you grow revenue, that money comes down to the bottom and goes into my pocket, not into rebuilding a new plant or something. So being really capital efficient, that is revenue to assets or revenue to capital. We, in the companies I'm involved with, I always give them to measure return on invested capital. So the higher revenue is to those assets or capital you've got to put into to expand the business, it's really important. So all of those come together, and you come up with a number for your EBITDA margin, and we'll see it in the model when we go through it real quickly. We have a few minutes, right?
Sure.
Okay. Okay. So in the end of all this, what are you able to say? You're able to say, I'm highly confident. You'll all say that, right? With a straight face, I hope, that with X dollars of financing to cover my cumulative negative cash flow, but with X dollars of financing, we can build a business worth X dollars in 5 years. Okay, that's the end. That's what you're really trying to tell judges, investors, whatever it is, that that's what really tells the strength of your business model. Obviously, the more value you can get with the less financing required, the more attractive your business model is. Okay, and again, when you really start going, then you'll get into real specific, these 3 key financial statements, but you're not trying to create those, you're just trying to do this cash flow projection. Okay? Ready to go to the model? Sure. Okay, so we've created a model that tries to help you get through this, to do this, to accomplish this, to be able to get to that final statement that we just talked about. So we'll go over some tabs here. Again, the first one is instructions. Important to read the instructions, okay? I can't tell you I've tried it a lot of times, just try to do something without reading instructions, get in a lot of trouble. What's important, you see this, you see yeah, perfect. So the highlighted in that color, that's where you've got to put in your numbers, your assumptions, whether it's days of inventory, whether it's, you know, your different expenses that you've got. Those are the ones you have to fill in. If they're not colored like that, the model will fill in everything else for you, okay? Including some that don't have any color, and then the real key lines, which are colored in green. Okay, so that's what you're gonna do. You'll see something for your sales, cost of goods, all these things. Go through them. Again, I think we've tried to explain it pretty well, but this is just a, you know, a reminder, if you will, when you're working through the thing, and it'll help you get to that final point. Okay? So sales. Oh. Okay, sorry, we're. Oh, really? Okay. Well, okay. Probably important.
And I know that individuals in the Innovation Center online, those that'll be watching the video, you may have some instances where your eyes gloss over here. You may be like, wow, this is way too much. Oh my goodness, I have no business background. But really, that is not an excuse, okay? That's not an excuse for Hawk Tank, without a doubt. Why? Because not only do you have the resources of Mr. Masner, the resources of myself, the resources of the Small Business Development Center, everything we have at the Innovation Center, but I think more importantly, we have the resources of Beta Alpha Psi. And so they are your experts, they are your consultants, because that's the great thing about being an entrepreneur and about being a business woman and a businessman, is that it's not expected that you learn everything. It's about that you understand how things are connected, and you understand where to seek information and where to get help and where to get guidance. And really, that's what Hawk Tank is about. There is zero expectations that you know all this and that you're gonna go it alone. That's not how we developed this program, right? And Beta Alpha Psi has been here for years, supporting teams that have won, supporting teams that have not won but have gone on to start their businesses, and that's really what Hawk Tank is all about. So those that are in here, that are online, that'll be watching the video over the next couple of days, please remember that. We have a room full of finance and accounting experts right now in the Innovation Center, that even if you are watching the video right now, that please email me, okay? So we can make these connections, and so you have that support. Okay, I just want to make that point really clear, because I understand this is some pretty intense stuff. Okay, but anyway, I just wanted to make that point.
Good point. And again, you know, you as the business model creators, you as the idea about what you're going to have to fill in a lot of the numbers. The Beta Alpha Psi folks will be able to say, well, maybe you missed this, or we don't see anything here, or maybe that looks a little too conservative or optimistic. They'll tell you what they think. And the model really tries to make it as simple as possible. We really worked hard at trying to come up with something that you don't need to be, you know, to have a degree in accounting or finance to be able to fill it out. You just need to make some reasonable assumptions and to put them in, and the model tries to do as much of the work for you as it possibly can. It can't make your projections, how many sales you're going to get and all those things. That's yours. Or what kind of expenses you're going to need, but it really tries to add up all this stuff and come up with the answers for you once you put in the key variables. Okay, so again, here's sales. What you see is you can do it, it's got multiple ones, it will add them all up depending on how many you have. So by product, geography, or channel, you can do it. You can change, and again, what you can do with all of this is to change the headings, if you will. So, wait, that didn't go. Where's the laser pointer? Oh, it is right there. Okay, thanks, sorry. Okay, so, you know, specific market segments, put in the name, whether it's a product or it's my product going through my wholesale channel, whatever it is, or my sales I'm gonna make, and if you've got geographical differences. So you can change those and put in a specific title in that box that tells you exactly what it is. So it'll add all this stuff up. So again, you put in unit sales and the growth, you're going to put in a number for net revenue there because it'll have a specific, down here when you do it, it'll have dollars. Let me stand back here, do it, sorry. Dollars per unit, so it'll calculate gross revenue, goes through all of the other things to get you down to net revenue, adds everything up across the board and gives you the top level here of the total unit sales, total revenue growth of your business.
And remember, it's the yellow, right? The
Right.
yellow is where you're inputting, and the green boxes are where the calculations will be.
And or the white boxes, that'll all fill in for you. The green boxes are the real key summary kind of stuff, you know, that adds things together for you. But anything that's not colored in whatever that yellow is, whatever it is, that's, you don't have to enter anything in there. Okay, so now we get to the cost of goods sold that we went through. Okay, we've tried to get some specific numbers here, again, by product, because that's where it'll differ, not by channel that you sell it through. That's all in the revenue and discounts. But here are the costs. Again, you can change any of these headings or any of these numbers if you want to put something else in there because either it doesn't count or you want to describe it differently. You can put it in there. If you don't have any freight because you're selling an app or a software product, just leave it blank. It doesn't need it. You can put things in there. Again, what we try to do is the purely variable costs that are going to literally be per unit. Now, again, maybe go down a little bit over time in material or production labor. And then the more fixed costs, you know, production rent, warehouse, utilities, the supervisor, you know, the managers that are running the factory, those kinds of things. And so you'll build those up a little more slowly with absolute numbers. It won't be a per unit calculation. Okay, again, different products you can put in. Now we get to the operating expenses. We talked about it before by the three primary functions: sales, marketing, product development, or R&D, engineering, and then G&A. And again, you can put in anything, you know, if you say, well, here's my cost, I don't really have this one, here's what I have, just change the titles wherever they are that you want to change to be specific to your business model.
One thing I'd like to point out, and this is something that we've mentioned multiple times, every single sheet will have a huge list of assumptions, be it sales, be it COGS, be it operation expenses. And once again, judges will really look at this. If this is something that you are submitting with your business plan, please have a sounding board, right? Be able to sort of explain your estimations, explain how you came up with these numbers. I've said this before. I think these assumptions are what really makes a difference between the team that wins $5,000 or $10,000 and maybe walks away with $1,000. Okay, I really truly believe this, and I also believe this in the real world, that it's these assumptions that ultimately sell your investors. Okay, more so than the numbers. It is your assumptions. And so I think those are really important.
Yeah, that is, and I'm really glad you brought that up. It's in the instructions and I skipped it, and I shouldn't have. When you have an assumption like that, make it a note in the box, right, in the cell that you're referring to. And you can do that, right? It's easy and under review. You just hit that and it allows you to put a message, you know, in the box and it does this. You see one I've got there. For products costing less than $1,000, okay? That's the message. It won't show up like that until you click on it. But put the assumption number, just make that your note for that box. Assumption 1, assumption 2, and then go down and detail the assumption that applies to that certain cell. Okay? Okay, now again, working capital. So it'll go back up to that. It will summarize for you back up to the level we want it, but essentially it's accounts receivable and inventory on the current asset side, and you just say, okay, I'm giving my customers X days to pay, and it will calculate the amount of receivables for you based on revenue. On inventory, you say, here's the days in stock I want. It'll tell you what your turns are, just so you can see that. You need to put in the percentage of of cost of goods sold that you are buying on the outside, not that you're handling internally to finalize the product, and then it'll tell you what your total inventory is, and then accounts payable, same thing. Okay, so you put those relatively simple things in, for instance, how many days suppliers give me to pay, and it'll calculate what your accounts payable is. Then we've got the capital expenditures, these fixed assets that we talked about before. And again, you can see by quarter for the first quarters, then this one is where it adds up for the whole year for you to use in it. And then, the next year's. And again, whatever the category is, whatever works for you, put it in there. We tried to use some general ones, but just to show you, and you put them in there. You put in what you really need. And again, you put them in each of them by category, and it obviously totals it up for you. Then you get to the cash flow, the free cash flow that we talked about. So it's starting out, can you go up a little? This is the detail. So here's the summary, if you will. So it starts out with it's just what we talked about before. Starts out with your EBITDA, takes out the growth in working capital. Now let me just make sure of that, because it's, when you buy assets, then it's not growth, you're just spending that money. But let's talk about inventory. If in quarter one, you've got $10,000 worth of inventory, and then you get some in, but you sell some, so the next quarter, you've got $10,000 worth of inventory, that's not an increase, right? You've already put that need for the inventory in, so it's just the growth in inventory that's gonna cost you cash. And so it'll calculate that for you. You just put in, it'll tie it into revenue, and it'll calculate it, but it's the increase in working capital, increase in inventory or receivables as your revenue grows and your receivables grow that you got to finance. So it's the growth from period to period, and it'll calculate that for you. Okay, so you're coming up again with free cash flow, right there. Percent of revenue, and by the way, on the other one it showed total working capital to revenue, and it'll calculate that for you. You can see what it is over time, see how hopefully improves a little, but not dramatically. And then it'll accumulate your cash flows for you, and only color in this, I don't know what they call it, pink or light red. I like a light red, but it'll highlight the maximum negative cumulative cash flow that you have. That's what you've got to raise in terms of capital. Okay, and then here's and then down below it'll fill in those detailed ones for you too, and show the growth, like we talked about, growth in AR, growth in inventory, growth in payables, so the total net growth, capital expenditures, free cash flow.
And I always like to consider this is the magic.
Yeah.
Right, this is the magic. This is really what this is the value that Mr. Masner has brought to Hawk Tank, brought to anyone that's ever used this model. This is where it all happens. And I love that it just fills in from all of your work, all of your assumptions, really cool stuff.
Of course, so here's the valuation sheet that we talked about, and it goes into those valuation factors that we mentioned. And it puts a range of EBITDA that you get for each, so you get some multiple of EBITDA for each of those specific factors. And so take intellectual property. So if you've got a patent, then you're going to get a 1 times multiple just from this factor. Okay, and again, there's no formula here, this is the way it's done. It's trying to come up with a method that works reasonably for everybody. Okay, so if you've got a strong brand that's not as good as a patent, but it's a lot better than just being another product, so it'll give you a half of a multiple point there. And if you don't have any of those, then you get 0 for that factor. Okay, revenue growth, again, faster you're growing, the more you're going to get. That's a big deal. Recurring revenue, if it's above 60%, you're going to get a 2. If it's below 20, you're going to get a half, so you're not going to get very much. EBITDA to revenue, again, the higher it is, the better multiple you're going to get, as we talked about. And same thing then with capital efficiency. How much, if you have a really relatively low need to put in capital to grow, to finance the growth of the business, that's better. Again, buyers get to keep all that EBITDA for their own use. So you just do this. Again, some of them, it'll fill in, the model knows what you put in and what your revenue growth was in the first year. So it'll put that in there for you. And then depending on what it is, you just put in which of the factors it is from those based on what the growth is. Same thing down here for EBITDA, and this one, I should have put in if statement there, but anyway, it'll fill it in. This one, the recurring revenue, it doesn't really know that. You've got to put that in here, and then, so you're filling in all of these. You're getting a total revenue number, or it'll add those up then to get to your total multiple. It'll take your 5th year EBITDA off your statement, and it'll say, okay, here's what I'm going to be worth in 5 years. So that's the number it comes up with. So again, not perfect, but we're trying to be relatively consistent across. Somebody might say, I'm going to be worth 30 times EBITDA, and somebody else says, nah, 5 times, you need some way of saying, here's why I think I'm going to be worth the high end of the 4 to 8 multiple, not the low end stuff. Okay? So that's, again, you can see that this model, again, back on the prior one, it showed you your total cumulative negative free cash flow, so what you need in financing or a capital raise to build a company worth, and there's your 5-year valuation that you're gonna propose that you're worth based on how much EBITDA you're gonna produce, and then what you think your multiple should be because of the various factors of your business model and your entire business. Make sense?
Any questions here? Any questions online, Preston?
Do you think it's doable? Yeah? Okay, I like a few nods. That was good.
Anything, Preston?
I don't see any.
Okay, great. So here's where we are in the evening. We first of all want to thank our Hawk Tank expert, Mr. Masner, for all his time, all his work, everything that he's done for us. I love this session. We have a number of Beta Alpha Psi experts here in the house. I know we have a number of participants, so we'll do some matching this evening. We'll exchange some information. I know we have 2 or 3 individuals online, so I'll jump on the chat and kind of see what your all's needs are. And if you're watching this video, and I know a number of you will for Friday, Saturday, and Sunday, please email me, mevaldez@fortlewis.edu. My contact information is online, as well as in all my emails. Reach out to me. I will help make the matches with Beta Alpha Psi, and you'll be able to work together. That's where we are. Just a couple sort of administrative things. Number 1, if you have not registered, the final deadline is going to be on Monday, and so there's plenty of time still to register to participate. Also, the end of the month is when your business plans are due. And so if anyone's looking for additional assistance, additional resources, please reach out to me. We can do working sessions, we can do it on the weekend, we can do it in the evenings. We are here to support you in these last few weeks, okay? And even if you're sort of beginning it now, we have all the resources. Everything is currently online under the schedules. That are the handouts, that are the videos from these sessions, as well as you have me and the resources at San Juan College and Fort Lewis College. So extremely exciting. And once again, thank you so much, Mr. Masner. We're so blessed to have you as part of the family. Any other questions? Okay, so I'll jump online. Thank you, Mr. Masner, once again.
Best of luck, everybody.
And we'll do some connections. Awesome, thank you, Gary.
My pleasure.
Okay, so who needs help or who wants to